Okay, there we are. All right, we are now recording, and it is about 2:35 Eastern Time on September 22nd. Okay, so Barry, back to your point. What's your expectation? What were you surprised by? We're talking about what happened with the Fed rate hike and VIX expirations.
I mean, I held steady and followed the math, but I mean, it was definitely a hard hold because you're seeing supply day after day reach all-time highs, and yet the market going into the Fed was up.
Yeah,
And to me, that just foretell, okay, at some point they got to pay the piper. And so I stayed fast there. But now as I look at it, I'm thinking, okay, how much time do we need for supply to really bleed off to benefit the markets to the upside? That's kind of the question I have now is
yeah.
how long is that going to take? Because that would take some time or it would take some abrupt movement in the market to take off that supply.
Agreed. And there are parties to that, most of them market makers. And so we'll look at that. One of the core things I wanted to do this time around is to look at what worked and what didn't around options expirations. And you all know, if you've attended these at all before, Tim, nice to see you, it doesn't mean I get it right all the time. There's temptation but I don't prefer to trade during options expirations because things don't behave the way that you could count on in any other circumstance. And I do want to cover that. And
And
before
I
I get,
experienced that.
yeah, so did I. I had to leave two positions that cost me, and it was as I've said before, I will never make the mistake I did with Shopify. I won't make that mistake again, but I'll make some other mistake. So then one would be, oh, it's so tempting. You've got these great supply demand divergences, and we know we can count on those almost like clockwork in any other circumstance, particularly if you buy you've got this great supply demand divergence, and then the stock, whatever it is, has 5% volatility. That's intraday movement between high and low, and it's down 3%. Under almost any other circumstance, nothing's guaranteed except death, taxes, and it used to be Pena Boulevard would be plowed in Denver. That's off. That can no longer be counted on. But you have a very high mathematical probability of getting a return. But that breaks down during expirations, and we should talk about why. And it's always good to go back and look at the things that looked good and how did they do, so that we're reminded of what works and what doesn't. Okay, so let me share my desktop. And while I'm doing that, I've got two things to update you about. Let's see, here we are. Okay, I'm sorry, that's my calendar, one of them. Okay, so the two things are, number one, these updates that we have pushed to, that I said by Friday the 16th, if we're on track, they should be ready. The team did. The team had them ready in the test app. By the way, you have access to that. The trouble is it doesn't mirror your version of the app. So it won't include, you can see my screen. I have all these like airlines and cruise ships, when the test environment was created, whatever existed then is what is there. But you can do it. You can go to test.marketstructureedge.com, and your same credentials will work for it, and you can try these things that we have in the test environment out. But there are a couple of bugs that I'm not happy with. I think they're bugs. They're saying, oh no, we just flush the cache and everything's fine. But I want those to be worked out. But I think that we will be able to have them out by next week. And those are principally adding in the capability to, sorry, let me go. There we go. Adding in the capability to query by a very short-term trend. Now that we know that when supply falls day over day over a 5-day period, and demand doesn't, or demand rises, those clearly increase mathematically the probability of gains. That's in there. Volume is in there, one of the things that you've asked a lot about in the portfolio view, but that means then we have to free up room. And so there are a few other little things in there, but that stuff is about ready. And so when it is, then we'll do a short video on here's what we've added and here's how to use it, and then we'll test it, and get some feedback. I've been testing it, and I think those things will be good additions. Sorry, hang on one second here. And the other little thing is I'm out the next 2 weeks with apologies. It's just been a year where I've had to do a lot of coming and going. And so next Thursday and the Thursday after that, I'm out. And I apologize. Could I do it? It's just very difficult. I'll be in Italy, and it's just, I don't know where I'm going to be at 2:30 p.m. Eastern time. And so rather than try to sort that out and then blow it, I'm going to skip the demos the next 2 weeks, and I'll try to make it up to you afterwards. So apologies for that. That's it, I think. Okay, so now we can get into the swing of the things that I wanted to cover for sure. One of them is, we say when the market is up into options expirations, it tends to be down afterward. And I hear, well, what do you mean by that? Do you mean prices? Do you mean sentiment? Which one is it? And to me, it's sentiment. If sentiment is up into expirations, it tends to be down afterward, and so then the market tends to follow that. Well, what happened this time around? The market moved first. Let me go back over here. We had a lot of people registered for this thing, but I never know who's going to show up. Okay, so this is what I mean. Generally, when the demand side, let me increase the size there a little bit, is rising into expirations, it will be down afterward, and the market will tend to obviously follow that. There's very high correlation. It's not perfect, but it's a very good read. If you go back here and look at in fact, let me do this. Let's go back just a hair. I want to go back. Let's just go back 3 months. I think that'll do it. Is that right? Yeah. Okay. That'll just give us a good look. If sentiment is topped, then the market tends to fall. And once sentiment, the green line, the little green squares, those are options expirations. Gray is is SPY. When sentiment bottoms, that was a very strong bottom, one of the strongest we've seen. There's a very high probability. It doesn't mean it's linear. It can go up and down, but the central tendency is going to be that the market rises and until it tops. And then, then you get a little pullback, but the broad sentiment stayed right at 5 or thereabouts, very strong. It didn't give us another entry point. So then what would we expect? The stock continue to go up until we're above that red line. And it stayed up there a long time, but we know once it tops that, I've always said, the probability, once the market gets above about 6.4 of additional gains is 0. Now, that doesn't mean it will be immediate, because the market gave us plenty of opportunity to trade. We just know that generally we're very close to a top. And sure enough, if you step forward, it took the better part of 3 weeks. The market is lower than where it was then. That will be the length of time that the market spends with strong demand can stretch it, but it's very statistically reliable. And sure enough, the market topped and went down. And now with the sentiment bottom, then the market gave us very brief upside. Then we hit options expirations. If there's going to be a before or after move of prices relative to demand, it tends to be around options expirations. And of course, the supply side, this is what we have to refactor in the profiler. We have to factor in the effect of the supply side, and that's going to take us a little while. It's why I've said I can't, until we've done that, it's a very blunt instrument. But this is the big issue. And Barry, this is what you're talking about. How long does it take for that to revert? And will it? And if it does not, what will that do to the market? Well, I'll say if demand falls and it didn't even get back to 6, weak tops precede drops. It's one of the things, little quips that have been very accurate. Then I think we could have real trouble. I'm not saying we will. It's the end of the quarter. Things can change. The supply side could really come down, Barry. If it reverts to the mean, to the trend, then we're going to cushion the risk. But if it doesn't, I think we could get really clocked, and we will see lows worse than June. Again, I'm not saying that's going to happen. It's not fundamental. It's purely market structure, quantitative. But here's the thing. I wanted to look at some of these names and interrupt me at any time. I wanted to point this out, that demand rose and yet the market fell apart ahead of when it maybe should. But it was right at options expirations that we ran into trouble. Had this very nice run that reflected a plateau in the supply side and a bottom on the demand side. Well, that's going to give stocks the opportunity to rise. And there were some very good opportunities to trade in there. But let's go look at some of these things. Here's what I wanted to do. I want to really focus on I went back and looked at the market desk notes. I use the math. I trade the same stuff I put in those notes. I bought LNG today. It dipped, and it's a good supply-demand balance. My concerns are the broad sentiment is deteriorating, and the natural gas group is not generally strong. There's no question LNG is the strongest of that group. Well, those are risks. They increase the risk. But let's look at SBUX. So let's go over here. Now, one of the ones that I pointed out last week and said, well, if I look at this rising demand and falling supply, that's very favorable. I missed the fact that they had an analyst day. Again, I'm very careful around news or earnings because things can change. That's introducing information that people have speculated on. There can be reactions to it that then cause the math to be altered in ways that we wouldn't anticipate otherwise. It's a highly mathematical market. So if you don't have those things, the math is very predictive. Now, I stayed in it because I said, well, everybody's betting long that this analyst day is going to produce a reasonable return, so I'll stay. I'll stay on the basis that this low short volume, the supply side is telling me there are a lot of long bets. That doesn't mean those pay off, by the way, and we're going to look at that. But it turned out fine. Then what didn't turn out so well at all, I didn't lose very much, but I lost money on Altria because I looked at this and said, here's, where are we? Right in here. So, demand it's a big and stable, doesn't move a whole lot. And if you're new, I'll show you what I mean. Spent a lot of time at 5. Supply, big deficit here in the supply side. So I'd look at that and say, well, that stock should rise. I mean, that's where money's going to go. That's a clear low volatility hedge, and it's a great illustration of the risk into options expirations. That the math that only works if the parties who've taken those actions don't lose money. Well, maybe they did too. If they bet long and those options expire and they bought calls, well, then they blew that money because the price never got to where they hoped. And so they expire, or maybe they even sell them. And if they sell them, then that devalues them, and the parties that sold them get to keep the premium. And if it's a bank, they will have a hedge, maybe an inventory position. They just get rid of it, and all of that causes prices to deteriorate. So, the moment the equation changed, the moment that this ticked down and supply was above trend, I just had to. I had to leave. It was the price moves more than you think intraday, so I didn't lose that much, but I lost some. And I followed the math, and it was a reminder to me: this is the risk that you take if you hold something right into options expirations. It may not behave like it should. And here's what I mean. I said I'd explain this. So, what do I mean by volatility? And let me see, that is a consumer staple. This is another thing I asked the team to address. When you're looking for a stock in portfolios, it looks at notes, it looks at name, it looks at ticker, and it's too much. It's too broad. I said, just focus it on ticker. So when you do that search, it will show you only the ticker in portfolios. So we'll improve that. But I think it's in here. Am I right about that? You experts out there, I think it's a consumer staple, right? Yeah, there it is. Okay, so here's what I mean. This is intraday volatility. It's less than SPY. It's way less than the S&P 500 overall, which is 2.8% intraday volatility if you took an average. So 1.6%, that's a stock that tends not to move very much. And under ordinary circumstances where the context does not include options expirations, a supply-demand divergence in Altria can be a very good way to produce modest gains when everything else is struggling. So that's what I'm pointing to. It has all the characteristics I really like. Spends a lot of time at 5. It's very liquid at $8,600 a trade. That's right up there in the top, call it 250 stocks in the market. It's a large cap. But it didn't work. And there are other examples of that. And I'm just going to go through a series of examples so that we learn. The best way to learn is time in the saddle, as we say in cycling. Lots of repetition. Philip Morris, again. Barry, you and I have had we've made a lot of money trading this stock. And in this case, it was once again a very similar issue. The September 13, which is the day before the supply side in the broad market hit an all-time high, record high, and we looked at the rate of change too, and we thought, boy, that's not good. And sure enough, it then destroyed what would otherwise be probably a very reliable outcome, where you have 5.0 stock that isn't very volatile with insufficient, supply below the trend. Those are the conditions we like. Not enough supply, very stable demand, but it got clocked too. And so without that divot, the price would be up here instead of down here. So now you can see that the supply side is rising. Demand's fine, but the supply side is rising. If you're in it, you want to use that as your signal to leave. Let's go find something else. The supply side at 50% and well above trend there doesn't mean it can't do fine, but there are better things to do. You should take your gains. But I didn't own that one. I owned MO, but look, it didn't do what we had hoped it would do, right? And it's just another example. I want to look at Rivian. Those were big and stables. Now let's shift to the other side of the coin. And I'm sure there's a better name for it than volatile tens, but that's how I think about it. That stocks that have demand that gets all the way to 10 and the supply is falling. This is just right at trend. It's not awesome, but that was the high point, right into options expirations. Rivian did okay. And if you traded the intraday volatility, probably fine. But those things become unreliable during options expirations. And that's just a lesson again. I only want to point it out so you realize that the risk increases around options expirations. And I think that's right. Consumer discretionary. I want to go look at the intraday volatility. Yeah, five. That's what's really nice. I like to trade stocks like that because you have the possibility of capturing some part of that. That gives you a really good target. So, if Rivian's 10 and has declining supply, and then it's down, let's say 3% on a day where those conditions exist, I have a very high probability of making 3, 4, 5, 6%. Because if it moves back up 3 and maybe a little bit more to the full range of 5%, boy, you could do really well. And it's pretty liquid. It's quite large. There are all things here that can be very appealing. But once again, during options expirations, it was very, very challenging. It didn't continue to rise. And so then the question is, why does that happen? Well, it's because of that derivative side of the coin, where you have implied demand or implied supply through calls or puts. And of course, there are many more sophisticated things than that. I had a guy here visiting from State Street yesterday, and we were talking about the hedging strategies and how complicated those are. State Street is executing trades for a large institution, a Fidelity. And they're moving billions of dollars and they're not using their own capital. They're doing it as what's an agency broker, stuff Habib that you will know, as an agency broker, and they're doing it as a riskless principle. They're going to hedge their exposure. So if I'm out there working the market and it could cost me money executing these trades, because I've said to the customer, we will charge you this amount to accomplish these things, then you have to protect yourself against the possibility that you have to pay more or something, because you've guaranteed what this is going to cost. Now, can your cost of execution meet that? And so they're very complicated hedging strategies that fit into that behavior that we call risk management. That's why we track that. And that stuff expires. And so the math can look great, and then all of a sudden some implied demand just vanishes. The demand might show up as a deficit in supply because it's a derivative. And then, well, that's out of the way. Now all of a sudden that demand's gone. And once again, the big parties that may own some proportionate amount of RIVN, not as an investment, but as against the it's like an insurance policy, the possibility that we have to cover something, we better own the asset. But then they just dump the asset, because they're not investing in it. And so then that hits the market and boom, something that you're not expecting happens. Well, there's a much higher probability of that occurring around monthly and quarterly options expirations than there is at other times. So you just have to be aware of that. End phase, another one I want to look at. Examples are great. And interrupt me at any time, ask a question, give an example, and we'll take a look at those. So here was a great example of that very short term. You hit 10, supply is way below trend. Can you make money? Yeah, you could, and probably did. But boy, was there a lot of price movement in there. And so that, it's riskier than it might be at other times. And there's no question there was more price movement here than what there is normally. And once again, the moment that deteriorates and supply moves above trend, either side of the equation moves, that to me is a reason. And if you really, and sometimes it's hard. You say, well, I mean, it could be a delay. Maybe it'll continue to, maybe I'll get something else out of it. It's better to just, when the supply-demand equation changes, move on. Really, 9 out of 10 times it's going to work for you. And if one of those times doesn't, just take the lump and go change it. And we all have to do it sometimes.
Hey, Tim.
Yes.
I think you've said sometimes, like during the option expiration week, that they're increasing short volume in anticipation of demand. How do you recognize that situation?
It's a great question, and I'd have to let's see if we can find some examples of that. GME is oftentimes a good example of that, where the trading is heavily concentrated at retail, firms that buy retail order flow, like Citadel, Virtu, Jane Street. And I would argue that there probably was some of that in here. So I would look at it and say, "Ooh, that's a fool's errand to buy." I'm not buying GME when demand has fallen off the cliff to 1, but a bunch of retail diamond hands traders might. So then Citadel is going to create supply to meet that. And for a brief period of time, it will cause the stock to rise. And intraday could be very strong because they're filling rising limit orders. If I keep putting in higher limit orders and Citadel looks and says, well, there's a demand, there's excess demand and insufficient supply, I'm going to create stock to fill those trades. That is exactly what happens. But now they've filled all that in, right? Right now, actually, GME is kind of appealing, right? You could say, well, it just got to 10 and there's a supply side deficiency. If I'm ever going to trade GME, those are the conditions. There's something, but something everybody else doesn't. That's what I mean, though. You can see those periodically. You could see it in broad sentiment over the 3-year period, where the couple of periods of intense meme stock behavior hit. One of those was here, right after, everybody's kind of flush in here with COVID cash, because there was a furious effort to get it out. So we had this steep drop on the supply side it's the lowest that short volume is over the entire period of time, and then a surge. That's market makers filling retail orders. And we saw it a couple of other times during that period of time. I think there was another surge here, as I recall. That also was retail flow. That's looking at that's the S&P 500, and they were tending not to be trading those securities, but there's still that effect that we could observe. And there'll be other examples. I mean, if we went and looked at, maybe we look at, I couldn't catch that. Say that again. Let's see. I'm going to look just at this. I think we might see it in here too. Here to me is a great example. And once again, it's a terrible time to be. If you know market structure, you would look at that and say, no way am I buying Bed Bath and Beyond there. I mean, it's a 1. But that's probably created demand that gave the price a little bit of a lift. It gave it a brief lift, and then people get fooled. Whereas if you looked at the supply demand balance, you would say, not touching that at all. So that's how you can see it. But it's, are you going to see it in the moment? Only if there's a sudden explosion of it and the price goes up. If you see a surge in short volume and the price goes up, there's a very, very high probability that reflects borrowing stock to fill orders. And the great majority of institutional orders get filled that way too. But then what we find mathematically is the prices go down afterward. I mean, that supply side imbalance, even if it's created for buyers, which is going to be the case a lot of the time, will have its day. It will hurt price. There's another great example. And the price exploded, and that's created liquidity. And there you would know. If you happen to write it up and it's a 10 and supply is that high, boy, you should take the gains. And look, you're not going to capture them all, but the data will help you know what kind of risks exist. And the moment that demand stopped rising, the run was over. The peak came right in the middle. But there's another example. How are we doing? Okay. I want to hit a few more while we're at it. Maybe skipping, and again, ask any question that you would like. I just keep hitting examples. I've mentioned Monday.com a couple of times.
Yeah, could you take a look at Tesla? Something there's confusing.
Tesla, yeah, can do. Raven, is that you? Yes, can do.
Yes.
So here, the MNDY is pretty volatile. So while the prices generally come down, if you use that volatility read, you say it's a 10 and supply dropped way below trend and it's down 3%, it's very likely that intraday it's going to go up 3%. And you take those gains and leave. But you're stacking the probabilities in your favor that way. Okay, so Tesla. Yeah, I mean, I look at that and say it's the only thing that would be challenging is that this occurred during options expirations. So what drove what drove demand to 10 could be options, and probably was. But from a supply demand perspective, that's pretty appealing. It's spent 1, 2, 3, 4. It's a fairly, if the broad market sentiment is deteriorating and it's been at 10 for 5 days, that the risk increases the more time something spends at 10 that it ticks down to 9 and that the run's over. But I'd look at that and say, wow, that is very good. And that's what you saw, right, Raven? It's very good. Yeah. This, rising demand, falling supply was great in here. Yeah.
Threw me off a little though is across the top where you have your data, I guess, your top be 45.6%. And then it says the supply is up. Yet I look at the graph and it's down.
So the difference between the trend matching the whole period, so the trend line matches this whole period, and but this is the short-term move. That's what we've added to the platform, by the way. It's the ability to look at that condition. Let me see if I can show you what I mean really quick. Test. If I can do this. Okay, that it's slower. It doesn't have quite the caching horsepower behind it that the production version does. But here's what I mean. So Raven, the that 30-day trend continues to rise. But if we wanted to look for 1 day or 5 days, now we have that capability. So this trend would be that trend would be up or down. But here we can look for, well, what happened? We want to see day over day decline or a 5-day decline. I can do equal to down, and now I can look for stocks that have a 1-day downtrend. So if I want to find something that just got to 10, let's say, so on the demand side, market structure demand is equal to, just going to say equal to 10. So it's something that just got to 10, and I want to see, and the trend, we want the trend to be up, which will tell us it just got there, right? Because it can only be at 10 and have an uptrend if it's spent 1 day there. Whoops. And this is without, I like liquid stocks, but this will enable us to look for that kind of condition now, something that we can't currently do. So then if we look at Airgas, what it should show us is Airgas just got to 10 and see it tick down day over day. See that? That's what we're looking for. That condition is better in a rising market than it is in a falling one, because it could hit 10 and immediately drop, right? It did that back here. 1 day at 10, still worked. You still got gains out of it. So, that's what I'm talking. That's the difference between that trend line over whether it's a default 30 days or over a 90-day period in the portfolio view. That's what that means. In the short term, it can certainly be down. Now you'll be able to do that. Okay, how are we doing? Just about out of time. Let's see. I just want to point out LNG because it's one of the ones I highlighted today. Why is this? What is good and bad about LNG, and how you might prioritize? I look at LNG and say, well, I like this. 10 out of 10. I don't mind if the price is down. It actually increases the probability of a return. And then this big drop on the supply side, that's all good. That's why I bought it. The risk to me and to you, if you did it too, is the supply is over trend. So all it did is get back pretty close to trend. Is that a risk? Well, yeah, it's a little bit more risk, but I'll take it. And the other risk is if you look at the group. So I keep a natural gas portfolio. A lot of these, honestly, I don't pay that much attention to. I do look at the sectors. I want to know what those are doing. This is, now I'm really honed in on what I like to trade and how to use the math to the best effect. I learn too. So I look at this the group, and it's down, down, down. 6.5.2, 6.2, 6. They're all falling, and Cheniere is the outlier. That's riskier, right? So if you've got one outlier in the group, what's the chance that Cheniere reverts to the mean? Well, that's what passive money does. So I realize that I'm taking a little more risk than I would ordinarily by buying Cheniere, because there's a possibility that it doesn't give me quite the opportunity for a return that I would hope, which is close to 4%. All of these guys move 5%, but Cheniere is the most liquid of the group. Okay, I have not covered everything that I could and sort of wanted to, but we're running out of time, so I want to make sure that I've answered any questions that we have, and I'm not missing any, am I?
One quick question.
Yeah.
So the typical Friday options expiration, are those days that we don't necessarily need to be concerned about, the typical Friday's option expiration?
Well, they're a big part of the market. There's no question. Somewhere around 35% of market volume is weekly expirations, but that's a very quick time decay sequence. So you've only got, it's a 5-day instrument. And so it's a very short cycle, and so it doesn't change that much between the beginning and the end. And number two, it's not what big, huge institutions are using because they're not liquid enough. Okay. So there's so much more weight in the monthlies and quarterlies because of the immense size, trillions of dollars. There are $800 trillion of notional value in derivatives that are exchange traded. So that's not counting all the stuff over the counter. And some portion, the largest portion of that is currency, interest rate in US government or government debt, treasuries, bonds, all that kind of stuff. But it's multiple trillions in the equity market, so it's the monthlies and quarterlies that really matter.
Cool. Thank you.
You got it. What else? Last question. Anything? Nothing? Good enough for this week? Okay, well, it'll be a 2-week break, but then we'll pick up, and I should be able to do these pretty much through the end of the year, I hope. I'll be in Charleston for November, but I'll be working from there, so it'll be easy. All right, you guys, good to see you. Have a good rest of the week.
Safe flight.
Thank you, Raven. Yeah, thank you. It's
Take
not
care.
fun. You guys too. See ya.